High yield, easy income, ETFs that pay you like crazy. Sounds too good to be true? That's the promise of YieldMax ETFs. We're talking tickers like TSLY, NVDY, AMZY, all dangling double-digit yields in front of investors. But here's the real question. Is this the smartest income play on the market, or are you being tricked into giving away your upside? Today, we're going to break down exactly how YieldMax works, why the yields are so high, the hidden traps behind them, and whether you should or shouldn't buy into the hype. So let's start simple. What even is a YieldMax ETF? These funds are what's called single-stock covered call ETFs. They don't just own Tesla or NVIDIA shares. Instead, they hold those stocks and sell call options against them. The money they collect from selling those options, that's what gets distributed back to you as income. Think of it like this. Owning the stock is like owning a house. Selling covered calls is like renting out a room in that house. You get extra income every month, but if someone comes along offering a huge price for the whole property, you miss out because you've already signed away the rights to that upside. That's the trade-off. Capped gains for steady income. Now, Wall Street knows people love income. It's irresistible. Nobody brags to their friends about an 8% gain over a decade. But tell them you're earning 50% a year in dividends, and they'll think you've cracked the code. YieldMax leaned into that psychology. They wrapped these products in flashy tickers tied to names we all know: Tesla, NVIDIA, Amazon, Netflix. They packaged them like candy, easy to understand, high-paying, and accessible to the everyday investor. And that's where the seduction begins. At one point, TSLY, the Tesla YieldMax ETF, boasted yields north of 70% annualized. 70%. That means, on paper, if you invested 10 grand, you'd be looking at $7,000 in payouts over a year. Compare that to a savings account that maybe pays you $400. It's no wonder people were drooling over it. Retirees wanting steady income, dividend hunters scrolling through stock screeners, traders chasing payouts. Everyone wanted a piece. But the obvious question is this: if it looks this good, what's the catch? Because there's always a catch. Here's where the risks come in. First, the capped upside. Let's run a scenario. Imagine Tesla rallies 30% in a year. If you own Tesla stock, congratulations, you made 30%. But if you own TSLY, you don't get anywhere close. Why? Because the ETF sold call options, and those options gave away your upside to someone else. You get the option premiums as income, but that's it. Meanwhile, the stockholder next to you is grinning ear to ear while you're capped out. Now flip the script. Imagine Tesla drops 30%. If you held the stock, you lost 30%. If you held TSLY, you lost roughly the same amount. But yes, you picked up some income along the way. That's cold comfort when your principal is bleeding. YieldMax doesn't shield you from losses. It only caps your wins. That's a dangerous combo. Second, single stock risk. YieldMax isn't like JEPI or QYLD, which spread risk across dozens or even hundreds of companies. YieldMax ties itself to one name. If NVIDIA collapses 40%, NVDY collapses right alongside it. Sure, you'll still get some income, but it won't matter much if your principal just got cut in half. Third, the payout illusion. Those massive distributions you see? They're not always real income. Sometimes they're classified as return of capital. That's just a polite way of saying they're handing you back your own money. You feel richer, but your ETF is quietly shrinking underneath you. Fourth, the volatility trap. YieldMax thrives on volatility because option premiums get fatter when markets are jumpy. But when volatility cools, the payouts shrink. That 60% annualized yield you saw on the brochure? That's not guaranteed. It's a moment in time. If you thought you locked it in forever, you'll be disappointed. Let's talk real examples. TSLY, in its first year, pulled in investors with those sky-high payouts. But look under the hood. The ETF's share price steadily trended down. Even with the dividends, many investors weren't actually ahead. NVDY told a similar story. Launched with fanfare, it looked golden. Then the reality of option premiums set in, and expectations crashed. This is the dangerous trap. If you only focused on the dividend yield, you'd think you struck gold. But when you calculate total return, price plus payouts, the shine fades fast. And this isn't unique to YieldMax. Covered call strategies always trade upside for income. Traditional versions like QYLD or JEPI accept the same trade-off. But the difference? Diversification. QYLD covers the NASDAQ 100. JEPI uses the S&P 500. That spreads risk across big chunks of the market. With YieldMax, all your chips are on a single company, and that makes the ride much bumpier. Now step back for a second and ask, why did Wall Street create these in the first place? Simple. Yield sells. They know most retail investors can't resist a giant payout number. It's the same playbook they've used with structured products, leveraged ETFs, exotic bonds, all designed to look flashy on the surface while burying the trade-offs in fine print. And here's the kicker. The funds always get paid. They collect fees no matter what. Whether you make money or lose it, the house wins. And this is nothing new. History is littered with high-yield products that promised the world. Remember MLPs, Master Limited Partnerships? Investors piled in for their double-digit yields in the energy boom. Then oil prices crashed, payouts collapsed, and portfolios got crushed. Or mortgage REITs, which dazzled with big distributions until interest rates spiked and their business model cracked. YieldMax feels like the latest chapter in a very old book. YieldMax ETFs aren't bad, just specialized. For those prioritizing income over growth and tolerating volatility, they may fit. Retirees with stable income might carve out a small allocation for higher yield spice without risking their core. But if you're young, building wealth, and relying on compounding over decades, YieldMax is like eating your seed corn. You're trading tomorrow's harvest for today's meal. You'll feel good now, but you'll regret it later when your neighbors' portfolios are bigger and healthier because they didn't sell away their upside. And here's the deeper truth. Wall Street packages these ETFs with a sugar rush of income, but they're not built for longevity. They're financial junk food. They taste great, they feel satisfying, but they don't nourish your portfolio. The stock market has always rewarded patience, compounding, and growth. YieldMax rewards urgency, cash flow, and short-term gratification. And if you treat them as dessert, fine. But too much dessert, and you wreck your financial health. YieldMax's success reflects investor desperation for yield. After years of near-zero rates, people crave income now, often ignoring risks. Just like pre-2008 mortgage-backed securities, high payouts can blind investors, until cracks appear, leaving retail holders exposed when the music stops. That's why skepticism matters. You've got to ask the hard questions. Where are these payouts coming from? What am I giving up in exchange? Is this sustainable, or just a marketing gimmick? Is this aligned with my goals, or just a shiny object being dangled in front of me by Wall Street? So what's the bottom line? YieldMax ETFs aren't magic money machines. They're financial engineering. They trade growth for cash, upside for income. And yes, for some investors, that trade-off is worth it. But for most, it's not the holy grail it looks like. If you really want exposure to option income, there are safer ways to get it. JEPI, JPQ, QYLD, all offer covered call income on broad indexes, not single stocks. Or if you're willing to learn, you can sell covered calls yourself on stocks you already own. That way, you're in control. But don't be fooled by a giant yield number slapped on a marketing sheet. Big yield doesn't mean big safety. In fact, it often means the opposite. So here's my advice. Treat YieldMax ETFs like financial junk food. Have a taste, enjoy the flavor, but don't make it your main diet. They can play a role if you understand the risks, but they're not a replacement for a long-term strategy. The market rewards growth, patience, and diversification. It doesn't reward shortcuts. And before I leave you, let me say this. Every generation of investors gets tempted by products that promise the impossible. High income without sacrifice. It never ends well. Whether it was junk bonds in the 80s, dot-com preferreds in the 90s, or mortgage REITs in the 2000s, the story is the same. Wall Street is creative, but the laws of finance don't change. There's no free lunch. So what do you think? Are YieldMax ETFs a genius income hack, or Wall Street's latest trap for hungry investors? Drop your thoughts in the comments, Smash that like button if you learned something new, and subscribe for more skeptical breakdowns of investing hype. Until next time, invest smart, stay skeptical, and never let a shiny number blind you to the risks hiding behind it.